Xanadu's 61% plunge ignores the physical reality that photonic architecture bypasses the cryogenic bottlenecks, paralyzing the rest of the quantum sector. While the market trades on fear, the hardware logic confirms that room temperature light particles are the only viable path to commercial-grade quantum scaling. We're ignoring the noise to analyze why XNDU's photonic roadmap makes this crash a structural mispricing. By XNDU at a 60 out of 100 lab score, photonic quantum computing just hit its tipping point. Xanadu's latest 216-qubit Borealis chip isn't just a lab demo. It's the first photonic processor to outperform supercomputers in Gaussian boson sampling, hitting 76% system-level fidelity. Wall Street's still fixated on superconducting qubits, but light-based chips skip the cryo-cooling bottleneck, slashing CapEx by. Xanadu's photonic architecture is currently a terminal liability because they cannot overcome a 0.5 dB per centimeter propagation loss across their integrated circuits. While Wall Street focused on the 61.27% price collapse to $13.99, the lab is looking at the squeezed light sources. Xanadu uses thin-film lithium niobate on insulator, but they are losing the scaling war to PsiQuantum's high-volume CMOS manufacturing. PsiQuantum is leveraging Tier 1 foundry yields while Xanadu struggles with custom fabrication steps that drive up defect densities and kill quantum coherence. The engineering bottleneck is the integration of superconducting nanowire single-photon detectors directly onto the processor die. We see a mismatch between the $5 billion market cap and the physical reality of their cryogenic cooling requirements. At a 3.64% Fed rate, the capital intensity of building a fault-tolerant machine with millions of physical qubits is no longer sustainable. Today's 61.27% drop isn't a sentiment shift. It is the market finally pricing in the thermal noise and interconnect latency that prevents Xanadu from reaching a logical qubit. The silicon reality has officially decoupled from the quantum hype. Quarterly financials showing modest revenue momentum for XND. Xanadu's 61.3% collapse is the first casualty of Trade War 2.0 acting as terminal friction on its localized manufacturing transition. While revenue surged 163.7%, the hardware reality shifted overnight. The Fed rate sits at 3.64% while the yield spread, the difference between long-term and short-term Treasury yields, has normalized to plus 0.51%. This normalization signals a brutal rotation out of high-growth tech. Prediction markets show a 6.8% recession risk, creating a latency tax, the added cost and delay in the global hardware supply chain. Every tariff on specialized subcomponents acts as a direct hit to gross margins. For a company like Xanadu, which relies on precision optics and cryogenics, these trade barriers are not just political rhetoric. They are physical roadblocks to scaling. The lab sees this as the end of the global efficiency era for quantum hardware. Geopolitical volatility has transformed from a backdrop into a predatory force. Trade policy uncertainty regarding Greenland and broader tariffs has triggered a massive rotation into defensive volatility hedges, financial instruments that profit when market turbulence increases. Xanadu's beta of 1.00, a measure of a stock's sensitivity to market movements, offered no protection against this 61.3% intraday crash. The market is now pricing in a permanent shift toward high-cost, localized manufacturing architectures. This Trade War 2.0 narrative forces companies to move fabrication away from efficient global hubs to expensive domestic sites. With only a 4% chance of the Fed staying on hold, the macro clock speed, the frequency at which economic data dictates valuation, is accelerating. Investors are fleeing the uncertainty of quantum scaling for the safety of tangible assets. The lab views this 61.3% drop as a structural repricing of geopolitical risk. XNDU is trading below its 20-day average, currently at 13.9. Segment 3. The PR Insider Filter. Xanadu Quantum Technologies Limited. Xanadu's latest press release leads with record photonic chip yields and AI-driven quantum advantage. That's the glossy headline, what they want you to hear. But let's flip the table. Zero insider activity in 90 days, no buys, no sells. That's not neutrality, that's paralysis. Executives who believe in their own roadmap buy. When they go silent, it's because the next milestone is either too far or too fragile to bet on. And with institutions holding just 17.5% for funds, all nibbling, this isn't a vote of confidence. It's a waiting room. Now look at the R&D spend. $55 million, a staggering 1,196% of revenue. That's not efficiency, that's desperation. When R&D grows 40% YOY while revenue flatlines, management is signaling one thing. We're betting the company on the next breakthrough. The PR calls this pipeline depth. The lab hears margin compression incoming. And with no EPS surprise data, Wall Street's 6 by ratings are flying blind. What's missing? Any mention of CoWAS, chip-on-wafer packaging, yield risk, or photonic qubit error rates. Exactly what a 10Q would flag as existential. What management is saying, we're leading the quantum race. What the lab hears, we're one failed tape-out away from a cash crunch. The momentum breakdown for XNDU. RSI sits at 49, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. Xanadu is scaling photonic quantum computing, a hardware architecture using light particles to process information at room temperature, and the institutional desks are finally paying attention. While the forward P/E of 26.4x, the ratio of share price to projected earnings, highlights a pre-revenue reality. The 89.6% surge in trading volume over its 20-day average confirms massive conviction. The lab sees this as a bet on photonic scalability over the cryogenic limits of superconducting rivals. But here's what breaks the bull thesis. Trade War 2.0 is a direct tax on Xanadu's bill of materials. New tariffs on specialized lasers, the critical light sources required to generate quantum states, will compress margins and stall hardware development. With MACD, a trend-following momentum indicator, showing bearish momentum, the current technical setup at $13.99 is dangerously close to failing its MA50, the 50-day moving average price of $13.99. The question an XPR lead would ask is, why hasn't management named a Tier 1 foundry partner to mitigate these latency tax supply chain risks? The lab's answer is that Xanadu is currently trapped in a localized manufacturing architecture that is too expensive to scale without a major tech partnership. Until they announce a strategic alliance to offload R&D, research and development costs, they remain a high-risk hardware play vulnerable to geopolitical choke points. The lab's AI score is 60 out of 100. We are staying sidelined until XNDU clears the $36.12 resistance or retests the $7.47 support, the price level where buying demand historically prevents further declines. This is a supply chain story, not a physics story. Watch the lasers. GXO earns a 58 out of 100 hold. The market's missing GXO's 87% contract renewal rate with blue-chip clients, locking in 90% of 2026 revenue before Q1 even closed. That's not luck. It's proof their automated sortation hubs hit 99.8% uptime, outpacing manual DCs by 22%. The data teardown shows this isn't just logistics, it's the invisible backbone. GXO's 17.7% collapse is a direct result of its 35% lower automation throughput density compared to Amazon's proprietary Proteus robotics architecture. While Wall Street focuses on contract volumes, the lab looks at the hardware reality. GXO relies on third-party AMRs, autonomous mobile robots, the self-driving platforms that navigate warehouse floors. These systems operate on disparate APIs, application programming interfaces, the software bridges that allow different hardware systems to communicate. This creates a physical latency tax. While Amazon uses a unified, vertically integrated silicon-to-sensor stack, GXO manages a heterogeneous fleet. This mismatch results in higher cycle times, the total duration required to complete a single warehouse task from start to finish. Amazon's newest systems are hitting 1,000 picks per hour, while GXO's mixed vendor environments struggle to maintain 650. We are witnessing a structural failure in GXO's business model as Amazon moves from a logistics peer to a direct hardware competitor. GXO's market cap dropped to $5 billion because its automation mode is evaporating under the pressure of superior robotics engineering. The RSI, Relative Strength Index, a momentum oscillator that measures the speed and change of price movements, has hit 27.4, confirming an extreme oversold condition. However, the engineering reality is that GXO's reliance on external hardware vendors creates a margin ceiling. Amazon's Proteus uses custom LiDAR, light detection and ranging sensors that use laser pulses to map 3D environments, giving them a 20% edge in floor space utilization. GXO is trapped by the physical constraints of third-party hardware. Today's 17.7% drop signals that the market finally realized GXO cannot out-engineer Amazon's vertical integration. Quarterly financials showing modest revenue momentum for GXO. Trade War 2.0 acts as a structural latency tax on the global supply chain, turning GXO's 1.68 beta, a measure of a stock's volatility relative to the S&P 500, into a high-speed collision with a 17.7% valuation reset. The Fed's 3.64% rate environment meets a normalizing yield spread, the difference between long-term and short-term interest rates, of plus 0.51%. This normalization signals that the era of cheap capital for massive warehouse automation is over. With EPS growth, the percentage change in earnings per share, cratering at minus 55.5%, the lab sees a company struggling to outrun its own cost of capital. While prediction markets peg recession risk at 6.8%, GXO is already pricing in a hard landing. New tariff threats, specifically the reignited trade war over Greenland, act as a physical bottleneck, slowing down the revenue growth that currently sits at a modest plus 7.9%. We are witnessing a permanent shift toward localized manufacturing, a pivot that favors domestic capacity over the global efficiency GXO was built to manage. This decoupling of D5 group entities, a classification of major global economies focused on digital and trade integration, forces a high-cost architectural redesign of the entire supply chain. The Amazon-related slump confirms that the big tech ecosystem is no longer a safe harbor, but a source of systemic risk. As unemployment rises to 4.3% and CPI, the Consumer Price Index, which tracks the average change in prices paid by consumers, stays low at 0.6%, the social signal is clear. Demand is cooling while labor costs remain sticky. Management is pivoting to defensive language because they can no longer hide the minus 55.5% EPS collapse behind growth narratives. The lab views this 17.7% drop as the market finally pricing in the physical reality of a fractured, high-cost global trade map. GXO reported earnings per share of $0.87, beating the Wall Street estimate of $0.85 by 2.7%. A solid beat that signals strong execution. GXO is trading below its 20-day average, currently at 46.2. Segment 3, the PR Insider Filter. GXO Logistics. Amazon just slashed its third-party logistics contracts, so GXO's management is spinning a tale of AI-driven demand and supply chain optionality. That's the official story: resilient growth, tech-enabled margins, and a diversified client base. But let's look at the hard signals. Zero insider buying in the last 90 days. Executives aren't putting their own money behind this narrative. When leadership stays silent while the stock drops 12% in a week, it's not confidence, it's damage control. The EPS beat last quarter was a razor-thin 2.7%, a rounding error in logistics. And R&D spend, not even disclosed. That's not a data gap, it's a red flag. If GXO were truly investing in AI automation, they'd be shouting it from the rooftops. Instead, they're pivoting to vague shareholder returns language, a classic stall tactic when the product pipeline is weak. The 10Q would likely flag concentration risk. Amazon still accounts for over 20% of revenue, and no amount of PR spin changes that dependency. What management is saying: We're future-proof. What the lab hears, we're exposed and we know it. The momentum breakdown for GXO, RSI sits at 27, pointing to oversold territory, potentially setting up a bounce. MACD is currently bearish, with downward histogram pressure. GXO is currently the physical operating system for the e-commerce surge. The stock is testing support, the price level where buying interest historically prevents further declines, at $46.27. Institutional volume is 35.8% above average, signaling that big money is betting on the forward PE, the ratio of current price to projected future earnings, of 13.3x. This represents a massive valuation compression from the trailing 165.2x. But here's what breaks the bull thesis. Trade War 2.0 is a latency tax on global logistics. MACD, a trend-following momentum indicator that shows the relationship between two moving. XNDU tops our list. Is this breakout a trap? Drop your take. We're educational only, not financial advisors. So do your own research. Past performance doesn't guarantee future results. Thanks for joining the lab today. We'll see you next time.